If you answer, I would listen to.
I can hear you. Like I only hear a few words, and then I don't know what happened. I can hear you.
Okay. Try muting your microphone. Okay, can you hear me better now? Okay. I can tell with the nod of the head there. Okay, so I made a couple of notes. The one thing, you might want to just listen to the instructor's screencast for the week, because one of the things he mentioned is some people aren't getting full credit when there's a team assignment because they're not including the group list and everybody that participated. And so I try to include that on all the assignments. Usually up at the top, you can just cut and paste that little picture, little table as far as who submitted it and who participated. So I think you're probably doing it, but just make sure you put those in when you submit yours, since I'm submitting all the assignments. There's 2 group assignments this week, both having to do with valuation of the venture. The first assignment, which is assignment 05, where they want you to value it based on the income-based approach, the market-based approach, and the asset-based approach. He said something in the screencast that there's not some of the materials that we need. And so for that one, what he wants us to do is, as a group, and you and I, Monica, can get credit for discussing this as a group, and what anybody that isn't part of this meeting is going to need to do is just give a summary of how you arrive at each of those 3 ways to value a company. And so then just submit that by email to the group, and then you'll be able to do what the instructor says you need to do for this, is just say that, where is it? Oh, it's in the notes from instructor. It says, for assignment 05, there's a missing document, so the instructions are incomplete. New venture valuation is an important topic. However, since the assignment is incomplete, I will not require you to submit this assignment. Instead, please look at the assignment and briefly discuss new venture valuation with your team. Use your team discussion board or your meeting or your email, however you want to do it. After your discussion, you should be familiar with the general concepts behind the 3 valuation approaches. Once you have done this post, I have discussed new valuation for new ventures with my team in the assignment 5 submission in iLearn, and that's all you need to do for that assignment. So we'll go ahead and discuss it briefly. The one thing that talks about it quite a bit is in the week's reading and video, the article entitled Valuation for World Minerals. And that goes through a company that used the 3 different valuation methods. And so the first one that he uses is the income approach. So if you want to value your business based on the amount of income it generates, there's two different ways that it describes in this paper. One is the single period capitalization method. So that's if you just use the income for 1 year. The other is the multiple period discounting method, which is for multiple years, but then you have to use the net present value, which basically says $1 today is worth less than $1 tomorrow, because if you took that dollar and put it in the bank for a year, you'd have more money at the end of the year. So basically with the income method on page 2 of that reading the valuations, it gives the single period capitalization method, which gives his company a value of $302 million. The multiple period discounting method gives him a value of $287 million. And it says, for purposes of comparing against the market and asset approach, I plan to use the income approach value of $287 million. So it's basically just using your income, the cost of capital, or whatever interest rate you're paying to investors or to the bank to borrow the money to get it going. And so it's basically a ratio of net cash flow to invested capital. So that's the income method. The other method is the market approach. And basically the market approach is you look at 5 similarly situated or sized companies, and then you compare your company to theirs, and you compare their value, their revenues, their capital. The criteria he uses are industry, size, growth, margins, capital, active, meaning their stock is trading actively.
Okay, I just wanted to, but I'm reading with you. I just wanted to say,
And a lot of this is mainly for the people that watch the video so that they can kind of follow along too, so they can catch up pretty quick and say that they were part of the discussion, or at least listen to the discussion. So it's the market one is where you're just comparing yourself to other companies. Another way that you can compare with market is basically if other companies have been acquired that are similarly situated, and let's say they were valued at $1 billion. Somebody bought them for $1 billion. So you can look at your company in relation to them, and let's say your company is half the size in sales and revenue and profit than that company. Then you could extrapolate that your company, since that company sold for $1 billion, your company is worth $500 million. So the biggest thing with the market approach is making sure you're comparing apples to apples, that you're comparing similarly situated companies and dollar amounts and sales and profit ratios and things like that.
The market approach is more like based on the things that you see, but I think it's more I don't know, more accurate, like the income or asset. Do you think?
The market approach, it's kind of like if you're going to sell a house, you can have somebody come in and appraise your house. They can say your house is worth a certain amount of money. So that's kind of just a hypothetical. And the asset approach and the what was the first one? the income approach and the asset approach, those are like an appraisal. Those are hypothetical. It's you're coming up with a value based on your numbers. But the market approach, somebody might appraise your house to be $100,000, but you can put it on the market for $100,000. You can ask $100,000 for it, but if all the people that I'm getting feedback from
Okay,
yours.
I believe income is the more accurate. That was my question. I'm gonna.
Okay. Yeah, but the market approach is really what your market says your company is worth, what somebody's willing to pay you for your company. And so at the end of the day, you can use the income approach and say it's worth so much. You can use the asset approach and say it's worth so much, but your company really is only worth what somebody's willing to pay you for. You know, a competitor that wants to buy you out, an investor that wants to buy your company for its future growth, whatever the reason, so the market approach is really you're looking at the market and saying, if my company was for sale, what would people buy it for based on what they have paid for other companies like mine? And in the alarm industry, kind of like in the industry that we're in, it's the way that people value alarm companies is based on a multiple of their monthly recurring revenue. So, and your monthly recurring revenue is, you know, if you have 1,000 customers that are paying you $100 a month for your service, then you're bringing in $100,000 of monthly recurring revenue every month. Now, typically, historically in the business, if you have $100,000 of monthly recurring revenue, then another alarm company might want to buy your company for your accounts for that $100,000 a month in revenue. And typically they'll pay a multiple of between 25 and 45. So, and it really, you say, well, why would somebody only pay you 25 times your monthly recurring revenue? So 25 times 100,000 equals, oops, I did that wrong. 25 times 100,000 equals 2.5 million. So you say, well, why would somebody pay you 2.5 million for your alarm business, but another alarm business might get like a 45 multiple, which would be $4.5 million. And they value the alarm accounts based on what they call the quality of the accounts. Do all the accounts have contracts? Do the contracts automatically renew? Have the contracts, what's the average age of the contracts? If you have a higher average age, it means your customers stay with you longer. And so there's a good indication that they'll continue paying that monthly fee. So all of those factors go into account. And so that would be a market-based approach to value an alarm company. So if you look at our 5-year financials and our projections of how many accounts we're going to have after 3 years, after 4 years, after 5 years, and you say, we think we're going to have average to better quality accounts, then you can just take the number of accounts or the number of dollars per month that those accounts generate and multiply it times maybe 35 or 40. And that would be a really good valuation for our company in the industry that we're in. So then the last one is after the market approach is the asset approach, and they show a some balance sheet entries. And it says the net impact of these journal entries on the balance sheet is 49,000, and total assets drop from 336 to 287. Because the balance sheet book value is not necessarily market value, it may be necessary to make further adjustments to the balance sheet based on a new appraisal of the company's assets. Purpose of these adjustments is to put the applicable assets and liabilities at estimates of their market values rather than their accounting basis book values. For the purpose of the study, I've assumed that the reported book value gives a market value of 287. So yeah, that's one of the problems with using asset-based valuation, is that you really have to look at how you're valuing those assets, you know, the book value of those assets, whether it was the cost minus depreciation, and that may not reflect what the value of the asset costs. And a big thing with that, with businesses, is if they own real estate or if they own land in a building, they'll be depreciating that land and building. And so after the period of depreciation, like with land and buildings, you know, it might be 20 years or 30 years. So after that depreciation is taken down to zero on the books, those assets will be valued at zero. But we know that they have a market value, that you could sell the land and the warehouse or whatever's on it for maybe $2.5 million. So those are things that I think with the income method, you really have to make some adjustments to it. So it's kind of interesting how he kind of lines everything up to where the three methods give them a calculated final values that are fairly close to one another, somewhere between 271 million and 310 million. And he says, based on this analysis, I would go with the income approach method and decide upon a freely traded value of 287 million, which happens to be the same value that was calculated using the market and asset approach. So I think he's just trying to be conservative and try to use those three to line it up. If anyone's watching the video and has questions, I would just kind of post them in emails to the group, and then we can respond. And so for this assignment, really all the instructor's looking for is that the group discussed it. And so once you've looked at this and maybe made some comments via email, I think that'll meet those requirements. The other team assignment is assignment 06, which is valuation of a company based on net present value of a 5-year forecast. Monica, have you taken B301 yet? Okay. I'm taking B301, which is basically how you evaluate businesses using different financial ratios and the time value of money, and it really teaches you how to do that. In the assignment instructions for assignment 06, he does have a screencast that you can watch, one that explains net present value, and one that tells you how to calculate net present value. I'm going to, when I emailed the group with the video link and the assignment instructions for this week, I'm going to attach an Excel file that shows just a real basic one, how to do it. And you can plug in numbers. You can plug in the investment amount that you spend, and then the cash flow that investment generates each year, and you can get those figures off the 5-year financials that Travis did a couple of weeks ago. So once the net present value and the internal rate of return, that just tells you what annual interest rate you're getting. It's valuable when you're evaluating whether to invest money. So if, let's say you have an investment that costs $250,000 and it's going to generate $100,000 the first year and $60,000 the second year and $30,000 the third year and $20,000 the fourth year, you can plug those numbers in and it will tell you the internal rate of return. It will tell you based on the value of the money 3 years from now, what that investment is going to give you as far as your return. And let's say you plug those numbers in and it tells you that your internal rate of return is 4.3%. But in order to get $250,000 to invest, you have to pay 5% interest. Well, obviously, you're not going to want to do that investment because you'll lose money. So this is a really good way to analyze investments based on what you project it's going to bring in future revenue, and you value that future revenue in today's dollars, which is net present value. So once you understand net present value, it's pretty easy to plug these numbers in. So what I think we'll do is we'll have everybody just kind of study up on their own the net present value and internal rate of return, plug in the numbers from our 5-year financials, and then submit that to the group, kind of like we did with the discussion board assignment last week. Just kind of do a little bit of study, bounce it off the group, and then I'll submit the net present value and internal rate of return for the group by Saturday. So if the group can, do a little studying up on it, plug in the numbers, and then we'll just compare what everybody got for.
Could you just give a due date for everyone?
Yeah.
People is sending things a little later than others.
Yeah, let's try to have our own personal analysis that we do submitted by email to the group by I think by Thursday night would be fine, and that way Friday and Saturday we can compare notes. I think that should give everybody plenty of time, and like I said, I'll submit that assignment at the end of the week. Everybody else will need to submit their own statement for assignment 5 saying that they participated in a discussion about the 3 different valuation methods. But that's the assignments for this week, and so I'll do a little summary email with a spreadsheet template for net present value. And once you watch the screencast or read up on net present value, the spreadsheet will make sense. It's not that complicated. The Excel formula for net present value and internal rate of return does all the calculations for it. You just have to put in the cash flow generated each year. And my spreadsheet, you can go up to 10 years. We'll just be doing 5, but you can just put 5 in and leave the other ones blank. It still calculates it just fine. So if there's any questions, just post an email to the group and one of us will look at that. I check the emails every day. So do you have any other questions, Monica? Okay, well then I will go ahead and stop the broadcast. I'll post the link and we'll go from there. Pretty easy week.